Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. I've got big news to get into today, and this is a warning. It's a warning for everybody listening and watching because I think it's so interesting to see this all throughout history. And today we are being told this time is different. Have you ever heard that one before? I'm sure you have, all right? But today it's really key to understand the depths of this, where we've been before and where we are right now. The first thing I want to look at is the Fed goes for it. What are they doing? All the intricacies, I will bring that to you. The second thing, Russia's gold. What's happening? And of course, how that relates to the sanctions. The third thing is the real estate debt. All over the world, real estate has been rising considerably along with everything else. And I think it's time that we pause and understand what's happening with the bond market, what's happening with interest rates, and see how that relates to real estate and you. So much more. Let's go. Here we have the yield curve inversion. I've covered this many times before. Essentially, what we're looking at here is a real telltale sign for the bond market. And this is something that, before I forget, was already occurring. When we get the inversion, which has happened right here on many of these different spreads, this happens to be the 2 and the 10 year. It was already on that trajectory all the way into 2019. And then, of course, we got to 2020 and things really got wacky, as you know. So I believe the trend was already there. But a lot of these, analysts and so on, they seem to ignore that. But I wanted to make it clear, okay? Look at the other examples. We can see right now the 5 and the 30 year, and you look at several of these. Can you see where the trend is? I think it's pretty clear that they are all going to invert. Now, as I've said many times before, it's not the inversion that is the signal. It's when we come back up from that tends to be the telltale sign of a recession incoming. It is a perfect, really, truly a perfect signal, but that doesn't mean it comes tomorrow. Absolutely not. It just tells us that things are getting wacky. Now, you know Jerome Powell, your friend and mine. Powell backed yield curve, silly thing to say, but anyway, I'll get into that. Yield curve gives Fed leeway to go max hawkish. And essentially what the article says, I'll show you some of it, is that the economy is doing well. And while we do have these yield curve inversions taking place, well, there's much more to it than that, and what previous cycles had to say this time is different. So we don't have to worry, and in fact, we can increase interest rates aggressively. That's what they're saying. Is that the case? Has there been an example of which the Federal Reserve has said something and then it actually came true? I don't know. Do you think so? Let me know in the comments below. We know that what they have to say is ultimately just there to pacify the markets or to navigate those markets if they want to bring it into one direction or the other. And they have to create this boom and bust cycle. It's not perpetual boom. It's a boom and bust cycle. So we need to be aware of that. Instead of fixating on ominous bond shifts like the 5-year rate trading above its 10-year counterpart and a flatter US curve, more generally, traders on Wall Street should take their cues from another corner of the debt world altogether, the short-term yield curve. And essentially just saying that this right here tells us that there is nothing to worry about, okay? That you can read the article for yourself, but that's long and short of it. It's becoming more and more clear that the Fed is willing to risk growth to fight inflation. And I'm going to circle back on that line in I'll show you a couple things here, but remember that. Keep that in mind. There's a lot of these predictions where the Federal Reserve is going to end up at in their cycle. Some say that, they need to get it above 3%. Others say 3% wouldn't be enough. I do think that just a small increase is going to create somewhat of a catastrophic effect to the markets because they've been so addicted to so much easing that once we get into this a little bit, there's going to be problems. And I would also mention the fact that when you look at this right now, what's happening today, they are talking about a 50 basis point hike. But that's likely not to happen until May. So until then, we've got a lot of uncertainty, and I'm sure that the algorithms are being trained to look at what happens with, of course, Russia-Ukraine issue, as well as all of the different inflation numbers. Inflation comes in many forms, whether we're going to look at the CPI, whether it's the PPI, all different facts like that. And I will bring all of that to you. Of course, if you want to stay in touch, simply hit that like button. By doing that, you are more likely to see these videos in your recommended feed. It's all over the world, in fact, where we see rate increases, and even Canada is following along. Hawkish Bank of Canada speech puts half a point rate hike in play. That's right. They're willing to act forcefully. It's the same everywhere for the most part, except for China, where they are all going in this direction. So I wanted to make that clear. It's not just one central bank. Now, here we come circling around. The Go Stop Fed of the 70s. Too low rates led to the nosebleed rates of the 80s. Quote, the Fed did not hike rates high enough in the early 1970s to kill inflation properly, meaning that they had to overcompensate in the late 70s, early 80s, taking rates to 20%. Because they didn't do the job in the first place, it came back with a vengeance, and they needed to be exaggerated. So you think that the Federal Reserve, if they are going in this direction because of what happens with inflation, then watch out. That's all I'm saying here. They always go, if you notice, they always go too far down, too far up, too much money printing, not enough money printing, if that's the way you want to look at it, at least for the financial markets. It's always too late. Like everything is like exaggerated. So why wouldn't we expect it this time? Many people would say, no, it's just not going to happen. Because if this does, well, then the Federal Reserve is just going to go out there and pump more money into the system. But of course, it's not so direct, and you need to create a crisis in order to take advantage of it. They don't want markets to come down 10%. In fact, their official mandate doesn't even say anything about the asset prices, though we know they're concerned about that to some degree. I think it's important that we watch their actions and see what they've done historically. And here's just one example. So let's talk about Russia for a moment. Let's talk about gold as well. Many of my subscribers have been mentioning this in the comment section. I have noticed this, and I just wanted to bring this to you because I know this will be important. Information on the purchase of gold by the Bank of Russia on the domestic market. So this is actually coming from the official website here in Russia, and I just wanted to show this to you. In order to balance the supply and demand in the domestic precious metals market, Bank of Russia will buy gold from credit institutions at a fixed price. The price will be 5,000 rubles per 1 gram. The established price level makes it possible to ensure a stable supply of gold and the smooth functioning of the gold mining industry in the current year. After the specified period, purchase of gold can be adjusted, taking into account the emerging balance of supply and demand in the market. So that will be later, okay? We will see what happens. But I just thought it was interesting to say that. And then this, United States and allies and partners impose additional costs on Russia. What does that mean? Well, G7 and EU announced sanctions evasion initiative to prevent circumvention and backfilling of our unprecedented sanctions, continue to blunt the central bank of Russia to deploy international reserves, including gold. So they're trying to hit the gold market in Russia as well. So we will see what happens. I think this is so key. It's still, developing. So I don't want to speculate on what's going to happen, but you know that Russia has a lot of gold, and the central bank having this, they want to be able, other powers around the world want to be able to have a say in what happens here with trade, and we're going to see as it develops. What about this here? European Union's energy dependency. No doubt about it. That's coming a lot from Russia. You can see the EU imports, and if I show you that right here, EU imports crude oil, solid fuel, coal, and natural gas. A lot of that is absolutely coming from Russia. Unbelievable. And what happens to inflation if you suddenly cut Russia off? I mean, they are really, at a crossroads right now, to say the least. If you're interested, you could take a look at this. You could pause it. I'll try to get you a good view of that. You can pause that, or you can take a look at the link in the description. I just want to show you what's been happening here, and it compares basically from the year 2000 to the year 2020. And you could see a country like Germany increasing, whereas, others, Finland, happened to decrease somewhat over these 20 years. So it just gives you an idea of what's happening with the energy, because clearly this has a big impact on individuals. And that's going to bring me into the next part. We have to look at everything that's happening today. And I wanted to start with gas. State of America's gas prices. Look around the country and you will see how extreme it can be. It's not everywhere, of course. Look at Texas, $3.92. But look at California, $5.86. Some people are saying it's over $6. It all depends on where you are and so on. But people are paying more. That's the fact. Okay? State gas price averages, you can just look at this. It is, in fact, a record high nationally. Look at it around the world, though. I mean, it's truly extreme, to say the least. That puts pressure on individuals. And we see that right now with real estate. Pending home sales sink in February, setting a grim tone as housing market enters key spring season. This is the big one. Spring is when it happens, spring into the summer timeframe. Okay, usually we see more inventory. Usually we see more sales. Usually it's everything. But at this time, we're watching mortgage rates, which I think I have in here, right there. Mortgage rate soars closer to 5% in its second huge jump this week. So of course that's going to have an impact. People are uncertain. Okay. The situation is so crazy with gas. Okay, we're talking about high prices, we're talking about inflation. Californians find bargain gas prices in Tijuana. They're going across the border, if it makes sense, to go across the border and find that gas. Isn't that unbelievable how far people will go? And so when you have all these high prices, big expenses, real estate, cars, whatever it is, nearly half of millennials live paycheck to paycheck. That's higher than a year earlier. Now, that's this particular study, but I have shown you other studies. And even while searching for this one, I found another one back in 2021. This is a newer one. But I found one that was from 2021, a different study, said it was 71%. So, I mean, it depends how you look at it. But this is extreme. Because if they're living paycheck to paycheck, are they going to be able necessarily to buy into a house? So what does that do for the long-term potential of real estate today? Real estate binge pushes Canadian household debt to new record. New records all the time, every week it seems. Affordability index and sales year over year. This just shows us right now, we could see, by the way, a record plunge in affordability, but we could see the sales declining considerably as well. And what I've talked about many times before, but you have to think for just a second, what we must note with any asset, it is what the value of that asset is what someone is willing to pay for it now at this moment. Not what somebody paid for it yesterday. And things can change rapidly. Real estate, it goes slower than, let's say, stocks, right? You can kind of be a little bit slower with that. It's less liquid. But it's still so key to understand how that all works. The dynamics are very clear. And just one extreme example, bidder goes $613,000 over the asking price in this particular Toronto home. You could see it. It's probably 100 years old, been renovated. You look through it, it is a detached home. It's in a very nice neighborhood, a safe neighborhood. There's next to the good schools, the hospital's not that far, all that stuff. Okay. But we are talking about a home, Canadian dollars, of course, 2.6 million. 2.6 million. It sold in 2014 for just around 1 million. Now, you talk about extremes. I mean, do you need more examples than that? Anyway, that's it. If you found the video informative, hit that thumbs up button. I do appreciate when you come in here. Please don't ignore this information, okay? Because everything we are seeing today is leading up to something very big. That doesn't mean you sell everything and you throw it under your mattress and you go hide in your bunker. No, it just means you've got to take action. You've got to take the right steps. That's all. Hope you appreciate this. If you do, hit that thumbs up. If you're not subscribed already, you've got to do that, all right? It's so key because I bring out information every single day. I'll see you on the next one. Take care.